Imagine a world where your money is no longer truly yours anymore. Not because you spent it, but because you are no longer allowed choices. You cannot withdraw cash. You cannot store value outside the system. You cannot escape penalties, restrictions, or negative interest rates. If someone presses a button, your money simply stops working. This is not a conspiracy theory or speculative fiction. This is a direction openly discussed by central banks, economists, and financial institutions. Today we are talking about the end of cash, why they want to eliminate it, what reasons they publicly give, and what is actually happening beneath the surface. According to mainstream media, the argument against cash appears simple, rational, and well-intentioned. We are told cash belongs to the past and no longer fits a modern economy. Physical money is described as inefficient, expensive to manage, and technologically outdated. Officials frequently claim cash is primarily used for crime, tax evasion, and illegal activities. By contrast, digital payments are framed as transparent, clean, and inherently trustworthy. Supporters argue electronic money improves efficiency and reduces friction in everyday transactions. They insist a cashless society would save time for consumers and businesses alike. Another common claim is that cash causes frustration in queues and slows down daily commerce. Paying with cards or mobile devices is presented as faster and more convenient. This narrative sounds persuasive because it focuses on surface-level convenience, not systemic consequences. What is rarely mentioned is that cash transactions are final and permissionless. Cash does not require third-party approval, identity verification, or system authorization. Digital payments, by contrast, depend entirely on functioning networks and institutional approval. Every electronic transaction can be delayed, reversed, monitored, or denied. These limitations are framed as features rather than vulnerabilities of digital money. The official narrative also avoids discussing power asymmetry created by cashless systems. When money becomes fully digital, control naturally shifts away from individuals toward institutions. This shift is never presented as a loss of autonomy, but as inevitable progress. Convenience becomes the moral justification for removing alternatives and eliminating choice. One rarely discussed reason for eliminating cash is its role during financial crises. When people can withdraw cash, their savings become harder to seize or restrict. This directly limits the ability of authorities to impose bank bail-ins effectively. Bail-ins transfer bank losses directly onto depositors instead of taxpayers or shareholders. Such policies require deposits to remain trapped inside the banking system. Cash withdrawals represent a structural escape from this containment. This is why unrestricted access to cash becomes a problem during systemic stress. Recent history provides clear and documented examples of this dynamic. In Cyprus, banks were closed before deposits were forcibly reduced by authorities. Capital controls were imposed to prevent money from leaving the banking system. In Greece, banks were shut for weeks during negotiations with international creditors. Daily withdrawal limits were introduced to restrict access to personal savings. Citizens relied heavily on cash to survive during the shutdown period. Without physical cash, economic life would have been almost completely frozen. A cashless system would have amplified pressure on the population dramatically. Financial coercion becomes far more effective when no exit options exist. Removing cash transforms temporary crisis measures into permanent control mechanisms. What is described as financial stability increasingly resembles enforced compliance. Another central motivation for eliminating cash is the implementation of negative interest rate policies. Traditional monetary policy has reached its effective limits in most developed economies. Interest rates have already been reduced close to zero for many years. Central banks now argue that further stimulus requires pushing rates below zero. Negative interest rates are presented as a tool to encourage spending and investment. The official theory claims lower rates will reduce borrowing costs across the economy. However, this theory ignores how negative rates actually function in practice. Negative rates are not applied to households or borrowers directly. They are imposed on commercial banks through reserves held at central banks. Banks cannot freely lend these reserves into the real economy. The total quantity of reserves is determined entirely by the central bank itself. Individual banks can only shift reserves between each other, not eliminate them. As a result, Negative interest rates effectively operate as a tax on banks. This tax increases banks' operating costs and reduces already thin profit margins. Banks respond by passing these costs on to customers through higher fees and lending rates. Evidence from countries like Switzerland and Denmark confirms this outcome. Instead of stimulating growth, negative rates tend to suppress real economic activity. Cash provides a natural escape from this policy by allowing value storage outside banks. Eliminating cash removes that escape and enforces compliance with negative rates. Negative interest rates are often misunderstood by the general public and media commentators. They do not directly lower borrowing costs for households or productive businesses. Instead, negative rates are applied to commercial banks through central bank reserve accounts. These reserves cannot be lent out to consumers or companies in the real economy. Central banks alone determine the total amount of reserves in the banking system. Individual banks can only redistribute reserves among themselves, not reduce them. This structural reality limits the effectiveness of negative interest rate policies. When reserves are taxed through negative rates, banks face higher operating expenses. Banks respond by increasing fees, tightening credit conditions, and raising lending rates. This reaction has been clearly observed in countries implementing negative rate regimes. Switzerland provides a well-documented example of this unintended consequence. Rather than stimulating investment, negative rates discourage lending and economic risk-taking. Lower margins weaken banks and reduce their willingness to support long-term projects. Traditional banking models become increasingly unsustainable under prolonged negative rates. This environment favors large financial institutions engaged in speculative activities. Smaller banks focused on real economic lending face disproportionate pressure. Overall, negative interest rates tend to slow economic activity instead of accelerating it. Negative interest rates place disproportionate pressure on small and locally focused banks. These institutions rely primarily on traditional lending to households and local businesses. Their business model depends on healthy interest margins across the yield curve. Prolonged low and negative rates systematically compress these margins. At the same time, regulatory and compliance burdens have increased dramatically. Smaller banks must absorb high reporting costs with far fewer resources. Personnel and technology expenses rise while revenue opportunities steadily decline. As profitability falls, many small banks are forced into mergers or closures. Local branches disappear, reducing access to financial services in many communities. Small businesses lose relationship-based banking tailored to their specific needs. By contrast, large financial institutions are far less affected by these policies. They generate profits through trading, speculation, and asset price inflation. Quantitative easing disproportionately benefits institutions closest to financial markets. This dynamic accelerates concentration and consolidation within the banking sector. Power shifts away from community-oriented banks towards centralized financial actors. Over time, economic decision-making becomes less local and more remote. The result is a more fragile system, with reduced diversity and resilience. In a cashless system, all money exists only as digital entries. Every transaction is recorded, stored, and analyzed by financial institutions. Payments become dependent on continuous technological and institutional permission. Money no longer functions as a neutral medium of exchange. Instead, it becomes a system of access governed by rules and algorithms. Transactions can be delayed, reversed, limited, or denied in real time. Behavioral compliance becomes embedded directly into the monetary system. Spending patterns can be monitored, categorized, and evaluated continuously. Financial activity becomes inseparable from personal identity and data profiles. Loss of access credentials can instantly freeze economic participation. System outages or policy changes can halt daily life without warning. As alternatives disappear, dependence on centralized systems becomes total. If commercial bank credit creation is restricted, power concentrates further. The central bank becomes the primary issuer and allocator of money. Economic decisions shift from individuals towards centralized authorities. Surveillance is reframed as security, stability, and consumer protection. Control is normalized through convenience and technological integration. What is presented as progress may represent a permanent loss of autonomy. Cash itself is not the fundamental problem facing modern financial systems. Cash represents a remaining boundary against complete financial centralization and control. Its removal is not primarily about efficiency, safety, or technological progress. It is about eliminating alternatives and reducing individual financial autonomy. Without cash, money no longer represents ownership, but conditional system access. Every transaction becomes subject to approval, monitoring, or potential restriction. Financial freedom quietly transforms into managed participation within approved parameters. This shift is presented as inevitable rather than openly debated or democratically decided. The discussion is framed as technical, while the consequences are deeply political. A society without cash concentrates power in institutions, not in individuals. Convenience becomes the justification for surrendering resilience and independence. The real question is not whether digital money is innovative or efficient. The real question is who controls money and under what conditions it may be used. The future will be shaped by whether people retain meaningful financial choice. That choice, once lost, is rarely recovered without resistance.